Hi everyone, and welcome back to our series on financial literacy. Imagine waking up one day with the financial freedom to live life on your own terms. Sounds pretty amazing, right?
It does.
So investing is your ticket to that financial independence and long-term wealth. Welcome to the basics of investing.
Mike Albee, Chad Nurani, with bank interest rates typically lower than inflation, for those savings to keep up with inflation and your spending power over time, most of us are required, or at least prefer, to enlist the help of the eighth wonder of the world, often attributed to Albert Einstein, compound interest.
Pretty smart guy.
Really smart guy. Right. So investing is using your money to buy assets like stocks, bonds, or real estate, or really any other type of investment with the goal of making money over time. Now, let's define a few of these most basic investments, right? Cash, your checkings or savings accounts, or like your cash, like literally cold hard cash under your mattress. Bonds equals fixed income, another term for the same thing, right? Really a loan to anything. So the best example I could think of is like a mortgage, right? Like you take a mortgage, you buy a house, and you promise to pay back that loan plus interest over time. Stocks equal another term for the same thing as being equity, which is kind of like, it's like ownership in a company is effectively what that is. Like you buy one share of one of these big tech companies that we all love, you are technically an owner of like Apple or Google or Amazon or any of these other companies out there.
Very small owner.
A very tiny owner if you only own one share, but you are technically an owner of that company.
Yep.
And then there's other investments like alternatives. We hear a lot of that term out there, private equity and hedge funds, right? And I think really is other investments like real estate, even cryptocurrencies, things like art, wine, oil, other commodities, really a lot of other things out there, like call it those niche, investments out there, right? Really anything other than stocks, bonds, and cash.
Yeah, I mean, I try to just keep it simple. Stocks and bonds historically are the main building blocks of building a portfolio and creating long-term wealth. I like to drink wine, but I'm probably not investing in it. Not saying it's not a bad investment. It's just better to keep it simple.
Yeah, 100. For most people out there, right, you want to keep it simple. Cash, bonds, stocks. I mean, Mike, Mr. Portfolio Manager here, right? I mean, are stocks riskier than bonds?
It's true that without risk, there's no reward. And so while there's no guarantee that risk-taking will result in a financial reward, it's certainly true that few, if any, rewards come without risk. Therefore, these greater financial rewards become possible through the endurance of stress and the ups and downs inherent in these investments. Investing is a marathon, not a sprint. Patience can lead to better results. You have to know your risk tolerance. You have to set the goals. What are those goals? If it's a short-term goal, should you be taking on tons of risk? Probably not. If it's a longer-term goal like retirement, yes, you can afford to take on risk because you can weather those storms of those ups and downs and bear markets and recessions and everything else that come along with investing.
There are at least two other ways we can turn the financial stress of what we call volatility, right? The ups and downs of the stock market into favorable, right, desirable outcomes, right? And that's dollar cost averaging and rebalancing. So first, think about dollar cost averaging. I think the easiest example is for anybody saving in, like a 401k plan or a 403b, IRA, any right regular retirement savings vehicle, where you're putting a very specific dollar amount or percentage of your paycheck into the same account every paycheck or every month, no matter what. Right? When you do that, right, when the market's high, that same dollar amount buys fewer stocks or fewer shares. When the market's low, that same dollar amount buys more stocks or shares of a company. So when you think about that, when the market's down, it's actually really good for your account as long as eventually the market comes back up, which historically it has done. The other thing is rebalancing, right? That exact same philosophy of dollar cost averaging, but thinking about when stocks have done really well, right? Taking some of your winners and moving them into your losers. And it can be ultra counterintuitive, right? It's so hard from a mental perspective to say, this stock's done really, really well. Let me sell it and buy more shares of a stock that's done really poorly. The reality of all things though here is today's winners are often next year's losers, right? And today's losers are often next year's winners, right? So a hard thing to think through, but just look at the facts, look at the history, and it comes up true so often.
And Warren Buffett said it too. I mean, you want to trim or sell your winners and reinvest those proceeds and buy the losers. And that just helps kind of keep things in check and not saying trim those winners too fast, let them run a little bit. That's, you kind of set these risk tolerance and thresholds of rebalancing. So there's a a way to do it, a proper way to do it. But if you just let things run up, if you let your equities run up from 50, 60% up to 70, 80%, all of a sudden you've increased the risk in your portfolio as well. And is that risk you're willing to tolerate, and can you handle that?
Yeah, there's another really good mentor of mine when I was new to investing told me, just never let winners turn into losers.
Yeah.
Right. And so when one of your stocks has run up quite a bit, like especially if it's doubled in price, if you just sell out half, you've recouped your original investment.
Yeah.
And the rest is on the house, right? You're literally playing on the stock market because the original money you put in, you have back in your pocket to go buy another stock, make your next pick, and then you can choose when to sell the rest of it whenever you want.
Investing can seem daunting, but with the right knowledge and approach, it can be a powerful tool for building your financial future. Start small, stay informed, and remember, the key to successful investing is patience and persistence. Thanks for watching, and happy investing.